Happy Friday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Friday, October 21st, 2022, starting with our economic release spotlight. So we got some more high frequency data out of the US economy. And I didn't hear anybody talk about it on FinTwit. I just heard more doomsday narratives, more this, more that. But we spent the time to unpack it and feed it through our nowcast models. And so what the data points I'm referring to, of course, are yesterday's conference board's leading economic indicator and coincident economic indicator. We've talked on this channel and throughout our research about how the U.S. economy is booming from a coincident and lagging indicator perspective. And no more, we got no better evidence in that in this week to date. And then looking at the Conference Board's coincident economic indicator index, which is 4 different measures: production, income, employment, et cetera, for the month of September, that accelerated 110 basis points to a 3-month annualized growth rate of 3.3%. That's the fastest rate we've seen since December. And that 3.3% is more than double the pre-COVID trend growth rate. More than double the pre-COVID trend growth rate. On a coincident indicator basis, the U.S. economy is booming by a factor of at least 2x relative to the pre-COVID trend. If you look at nominal GDP, it's even more than 2x. Obviously, where we're headed is for a slowdown, and our forecasts, our models are very sophisticated, they're very accurate, and they point to a slowdown, and they tend to agree. And we got the leading economic indicators. There's 10 sets of indicators in that one from the Conference Board yesterday as well. That actually accelerated, but it's still contracting. It's contracting at a 3-month annualized growth rate of minus 4.1%. So clearly we're headed for worse times ahead from an economic standpoint. But the issue as it relates to financial markets is this, and I've been saying this all summer: the resilient economy is contributing to resilient core inflation. And because the Fed is focusing on these lagging indicators like inflation on a reported basis, the labor market, obviously 2 very lagging indicators, in terms of guiding policy, we got to expect that phase 3, which is tighter for longer, will persist well into next year. And Bullard more or less confirmed that the other day. By the way, for all my friends that says the Fed is making another policy mistake, what would you have them do? I mean, the reason we were in this mess in the first place is just because they were relying on broken and inaccurate models telling us that inflation was transitory. You want them to rely on those same damn models to guide inflation, guide policy now? That's so stupid. Let's just accept the fact and play the game for what it is and stop pontificating and just manage risk. At the end of the day, what we're trying to do here is help you make and save money. Everything else is a waste of your time, and it's certainly a waste of my time. And it's Friday. I have plans this weekend, mostly involving watching football and drinking beer. So let's just get into our Longbow dashboard. Anyway, going down global macro. Bloomberg dollar index here, that's bullish. Again, towards the upper boundary of the probable range, not quite there yet. Gold bearish towards the middle or towards the lower boundary of the range there, not quite there. Bullish treasury yields from a momentum perspective, we're actually getting overbought here. So you definitely want to be easing up off the short side of bonds. If you're one of these people who feel like they need to keep dollar averaging down in the bond exposures, we obviously aren't one of those people. But if you are one of those people who's long fixed income and needs to continue averaging down, this would be a good spot to be averaging down into that exposure, because fixed income, at least on the long end of the treasury curve, we're starting to see bond yields reach an overbought state in terms of the longbow trading ranges. S&P 500, that is neutral from an immediate term momentum perspective, still bearish medium term, right smack dab in the middle of the range. VIX, dangerous signal here. I'd say 2 things about the signal on the VIX here. 1, the lower boundary of the range has got a 29 handle on it. That's not good. 2, it's almost oversold. I mean, imagine an oversold VIX at 29. I mean, that's very frightening in the context of a lot of that Vanna flow really likely to come out of the market, starting next week from an OPEX perspective. So be careful there. NASDAQ, that is bearish in the middle of the range. Russell, bearish in the middle of the range. Bitcoin, Ethereum, both bearish. Getting towards the lower boundary of the respective ranges. Shanghai Composite, that's bearish, middle of the range. Same thing with WTI crude oil, bearish, middle of the range. Ag, bearish, middle of the range, more or less. And then industrial metals, bearish, still towards the upper bound or lower boundary of the range there. Shifting to my global macro dashboard. where we're sorting, sort of, several hundred different ETFs, all representing individual factor exposures across the global macro from an odds perspective. So effectively, what's got the best odds or the most upside downside, or sorry, most downside to upside. So we get things that are most overbought at the top of the list. Nothing really overbought here. So we'll just scroll down to the bottom of the list and see what's at the bottom. We got, Simplify, our buddies over at Simplify, the risk parity treasury ETF there is oversold, which makes sense. Obviously, bond yields are overbought here. 7 to 10 year treasuries are oversold as well, IEF there. So again, as I mentioned, you got 3 to 7 year treasuries. So Treasury Belly, 10-year treasury notes, Simplifies risk parity treasuries, which I think tries to replicate the return of the 30-year bond with 10-year note instruments and derivatives. All those things are oversold here. And as alongside that signal, you're seeing an oversold signal in regional banks. Obviously, regional banks like that NIM, that yield curve expansion, as opposed to that yield curve compression. So that's the yield curve narrowing of the yield curve recently. 10s, 3-month, 10-year has obviously weighed on the sector. So if you've been short regional banks, this would be a good spot to cover. I know a lot of investors actually have been long banks because they've been, they're actually, from a ROE standpoint, they're actually doing quite well from this point in the cycle, and loan growth is still accelerating. So, neither here nor there, but just wanted to call those signals out, featuring it on Longboard Dashboard, trying to help you make and save money every morning with this program. It's free money. It's free money. Now, it may not be free money every single day. Where I was talking to my production editor this morning, it's like, look, in financial markets, and maybe I'm pontificating a little bit, and I'll wrap it up and let you get on with your merry weekends, but you're only going to be right at most 65% of the time if you are a legendary investor. If you're Paul Tudor Jones or Stan Druckenmiller, you're right 60% of the time. If you're good at this, you're right, 55% of the time. If you're bad at this, you're somewhere below 50, and you're actually averaging down to the losers and selling your winners too soon. Don't do just do the easy stuff well, and leave the hard stuff and outsource the hard stuff to folks like myself, other people. I'm not saying we have it all figured out here at 42 Macro, but I do think we do a pretty good job of helping investors, both retail and institutional, manage macro risk. And so catch you back here Monday. Have a great weekend. Cheers.